Welcome to the IRS Debt and Audit Podcast with Brian Loughrin.
Hello, and welcome back to the IRS Debt and Audit Podcast with Brian Loughrin. Brian is a seasoned tax attorney based in Tampa and the founder of Tampa Tax Relief. For more than 25 years, he has helped individuals and business owners across the country resolve serious IRS problems, from audits to tax debt cases in the U.S. court system. I'm Lisa Mosby, and today we're talking about what happens when someone falls behind on an IRS installment agreement and how the IRS typically responds when a payment plan goes into default. Welcome back, Brian.
Hi, Lisa. How are you?
I'm well. Brian, many taxpayers rely on installment agreements to manage their IRS debt. What does it mean for an installment agreement to go into default?
Well, I think it means just what it sounds. Somebody sets up an installment agreement, which is the IRS term for a payment plan. And it's a formal arrangement that details specifically how much someone is going to pay on a monthly basis, and what day that particular payment is due. And to go into default status means, well, a simple situation would be somebody fails to make a payment or payments, or the payment doesn't go through. If it's done electronically, say it just doesn't clear the bank. Or in many cases, you find yourself in default status if you add an additional tax periods or years to the debt, and that can also trigger a default status. And in that case, the IRS will reach out by paper mail to people, and it'll say just that: notice of intent to terminate installment agreement. And it's a pretty serious notice that the IRS sends out.
And then what are some of the most common situations that lead someone to fall behind on a payment plan with the IRS?
Well, I think the majority of the time, from my experience, has been people adding additional tax periods or tax years to the balance. So if it's an individual, it's almost always filing a new return, and then that has a balance. And this system, it's all computerized, of course. It'll show balance due, and it will trigger some type of notice of intent to terminate installment agreement. In other cases, it's a situation where somebody may be on a direct debit payment plan. The payment doesn't go through. The money's not in the account. Or is a situation somebody's paying it manually. Say they're mailing in a check every month, the check doesn't clear. So it's really those two things. There's some other kind of very unusual extreme circumstances, but we're talking 99% of the time it's one or both of those situations.
And then once a payment is missed or an agreement falls out of compliance, how does the IRS usually respond?
Well, again, they'll send a letter. They don't call people. They don't put somebody in a car or run to your house and ring your doorbell if you miss a payment. They just don't do that. They don't have the resources. The system's not set up that way. They'll send a notice. And there's many times where a person, even a business or an individual, can miss a payment. Generally speaking, once a year, the IRS might send a letter, but usually they're not going to put somebody in a full-blown default status if that happens. But it's not something that you really want to poke the bear. If you find you're not in a situation where you can make that particular payment, then a lot of times people will reach out to the IRS directly to notify them by calling in. But again, if you file a subsequent return and there's a large balance, one of the things we tell our clients is, listen, going forward, if we put you in an installment agreement, you get your return done early. Doesn't mean you need to file early, just get it done. And if they tell you, hey, you owe blank amount, and it's an amount that's reasonable to accommodate, get it paid prior to April 15th, and then make sure you file the return after that. So that way things don't get crossed up with the IRS. But in some cases, people find that going forward, there's simply no way that they can satisfy subsequent tax balance. And if that's the case, what a lot of people do is they kind of panic and they don't file. And that's the worst thing you can do. You absolutely want to file timely, and that means even with an extension. That's timely if you file by the due date on the extension. But the worst thing they can do is not file the return because they owe a balance, and they know it's going to default the installment agreement.
And then in many cases, people assume that the payment plan will simply resume once they catch up. But how does the IRS actually treat a default agreement?
Well, if it goes to a full default, then they'll send a notice saying you have a balance, and you have to contact the IRS again, either online or by phone. And a lot of times people say, well, gosh, I went to the local IRS office here and maybe in Tampa or Orlando or some of the other cities around here. And gosh, I stood in line forever. I couldn't get anybody to talk to me. I said, listen, they're not set up. They're not a retail establishment. They're not set up for people to just go in and sit down and talk to them. And a lot of times what'll happen is people who want to do it that way, they kind of want to share kind of a hard luck story. Something's happened. Maybe there's been an illness that prevented income from coming in, or some type of other catastrophe in their life that put themselves in a situation. And I say, listen, the IRS is dealing with millions and millions of people on installment agreements. We have a pretty good way we approach it. And sometimes we do bring that information into either establishing or reestablishing a defaulted installment agreement. But oftentimes it doesn't play as large a role as people might think. I mean, again, the IRS is in the money collection business, and so for them, they just kind of want to get things back on track. But if you find that it's defaulted, you have to start all over again.
Can you apply this for folks? Can you describe maybe a situation where a taxpayer believed that their installment agreement was still active, but later discovered that the IRS considered it in default?
Well, and that's a situation where oftentimes people move and they don't update their address with the IRS. And a lot of people are of the impression that if they change their address at the post office, that's automatically going to notify the IRS. Well, the IRS sometimes will have letters forwarded to a new address, but there are a lot of times those letters are not forwarded. So you have to make sure your address is current with the IRS. And that's based upon either the previous filed tax return or a separate change of address form that the IRS has people send in. So somebody will continue to make a payment, and oftentimes they're just doing it set up online. And the IRS, of course, is going to take the payments and continue to either cash the checks or run the debits. And then at some point down the road, they find out through an updated address change or a new tax return being filed with a correct address that they're in default, and they're shocked. But what I tell people is they're going to continue to accept the payments and process the payments, even if you're in default status. But just because they're doing that doesn't mean you're in good stead. You're still at risk of other types of enforcement action. So just the fact that they're cashing your check or accepting those direct debit payments doesn't mean that everything's good.
And you mentioned other default actions. So when an agreement defaults, how can that change the IRS's collection activity or enforcement posture?
Well, again, a lot of it's how old it's been since it defaulted. Is the reason for it defaulting simply you stopped paying on it, or did you add additional monies? And then again, when I'm talking about adding monies, yeah, the system's set up, it's all computerized. If I tell people if you owe $1, that could trigger default status. Somewhat, they backed it off a little bit, but why risk it? Get it paid before you file. But usually it's a situation where somebody going forward has added substantial amounts, and it could be an amount equal to or even far greater than what they owed. And if that's the case, then it's again, that's definitely a situation where you're starting all over again. Because when you set up an installment agreement, it's based upon a situation where the IRS is wanting to get fully paid within the time that they have to collect. And it's not an automatic where they stretch it out for the longest period. If they have the ability to get paid in 6 months, that's what they're going to want. But if you add a new balance, that can definitely have a bearing on whether or not at that particular monthly payment, it's going to full pay the old balance and the new balance within the time frame. So the IRS system, it's all set up to monitor that. And if it looks like it's not going to happen, then they're definitely going to reach out.
So if there are additional tax filings or new balances added, as you mentioned, does that just automatically change the installment agreement, or do you start over and create an entire new agreement, putting together the old with the new filings? Can you just clear that up for me a little bit?
Well, it can be both. You have a situation where, let's say somebody owes X amount of money and they propose to pay a monthly payment of X amount. Well, it's a situation where the IRS is going to get paid maybe, let's just say within a year. You could take that same balance with somebody else, and the payment that they've set up, the IRS is going to take 4, 5, 6 years to get paid out. So a lot of it depends. In the first case, if somebody's making such a substantial installment agreement payment that it's going to full pay everything in less than a year, if they were to add a new balance, and say the balance is not even equal to what you're paying on, At that point, the IRS is probably going to not have a problem because they're going to get all their monies within less than a year, and assuming that they have a lengthy period of time to collect. That's still remaining. But in that particular case, the IRS is a lot of times it's just a phone call to say, hey, look, I've added a different balance. Can I keep the same payment? And they'll just look at the numbers. And in that case, the IRS says, yeah, it's fine. But a lot of it's communicating with the IRS and letting them know this is what's going on. I'm aware of it, and I just want to make sure what I'm paying is sufficient. And if it's not, then they will tell you that. A lot of times, though, people just kind of cross their fingers and they wait till it gets too far down the road. And in that case, you might find yourself having to start all over again.
And in your experience, where do people tend to misunderstand the rules surrounding installment agreements and staying compliant with them?
The number one thing is adding additional balances. People will file another year. And again, in some cases, just using simple numbers, if somebody has a current balance of, say, $50,000 and they're paying X amount, say $900 a month on a payment, and they file another return that they owe $6, $7, $8,000, and they're thinking, well, that's nothing compared to what I'm already paying on. Well, it's enough that it's going to trigger some type of activity on the part of the IRS. Whether or not that monthly payment you're making is going to be sufficient to accommodate both balances, it's difficult to say without really running the numbers. But the number one thing is people add balances and they just keep chugging along. And in many cases, they're not getting these notices because they've moved. They've changed their address. They're not getting mail at the old address. And a lot of times people call and they'll say, well, the IRS never emailed me. They never called me. And I say, well, they don't do that. They send paper mail, good old fashioned U.S. Post Office. So if you're not getting those notices, that means most likely they don't have your current address.
Here's where I want to wrap this up today. For someone who realizes their IRS payment plan may be in trouble, what should they understand about having a tax attorney step in to address the situation before enforcement escalates?
Well, call our office. I mean, in many cases, people call in if they're paying a very substantial monthly payment and they've added another year to it, I'll say, well, hold tight. You may get a letter saying, hey, listen, we can just incorporate this new balance into the current arrangement. You might get a letter that says, hey, this is a problem, but just keep an eye in the mail. But in some cases, people say, look, I don't want to take any chances. I've got a lot of activities going on in my life. I don't want to run it, and especially somebody who's maybe had their accounts levied in the past or some type of wage garnishment or property seizure. They say, I don't want to go through that again. So I just want to rather be safe than sorry. And we'll just kind of size things up. And if it's something that they can do just by making a phone call, we'll tell them. I mean, if it's something that doesn't require the actions or experience of a tax attorney, then we'll just tell them. This is the simplest, easiest way to get it fixed. In other cases, it's a little more complicated. And the thing I also tell people too is I look at the calendar and I say, what time of year are we in? If we're in October or November, and your prior year return added a new balance and you're paying on other years, the first thing I say is, where are you year to date? In other words, if you filed the current return for this year right now and say November, would you owe or be due a refund? And people, if they say, gosh, I don't know, well, that's basically them saying they're going to owe. And so I say, well, you know what? You're going to have to start looking at the current year in addition to the other year you added, in addition to the other year or years you're paying on. So sometimes it's something that not only is going to default an installment agreement, but something that you might have to kind of guide through over a period of time to make sure there's a soft landing on the other end, which means that current year gets filed. So a lot of times we'll consult with people and we'll explain to them how we can help with that, and also give them ideas on going forward, how they can find themselves at the end of the year not owing, because some people go year after year after year owing, and nobody's really sat down and explained to them how to set it up where you're going to finish this year at pretty much a break even. It's never going to be exactly right, but if you're making, say, for instance, 100,000 a year, and you come in within less than $1,000 one way or the other, that's kind of a break even level. And so we work with people on that as well as helping to either continue a current installment agreement or, if need be, reestablish an installment agreement.
And that's where we'll leave it today. Thank you so much. Folks, that's it for today's episode of the IRS Debt and Audit Podcast. To learn more about Brian Loughrin and his work helping individuals and business owners resolve serious IRS problems, visit tampataxrelief.com. Thanks for listening, and remember to leave a review, like and subscribe to the show so that you don't miss the next episode. And we'll see you there.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.